Welcome to the first episode of Learning to Invest in Cryptocurrency. If you're a beginner and don't know where to start, this is the perfect place. I will be uploading a series of videos to make you go from a rookie to a pro. But before you invest in something, you should really know what you're investing in. Just like how the S&P 500 is made up of different industries like tech, consumer staples, etc. Similarly, cryptocurrency is divided into 9 different types of crypto assets. I'll give you practical examples you can relate to for understanding. By the end of this video, you'll feel way smarter. Let's start with the god of all, Bitcoin. Think of Bitcoin like gold, but on the internet. Gold is valuable because it's scarce, people trust it, and it's been around forever. Bitcoin is kind of the same, but only digital. Coins like Litecoin or Monero, they're like silver or cash used for payments or private transactions. If Bitcoin is the Batman of cryptocurrencies, Ethereum is the Robin. Ethereum isn't just money, it's more like the iOS. It falls in layer 1 network. Just like how iOS helps different apps like Spotify or Uber function on your phone, Ethereum does the same for crypto. It helps in powering apps like NFT markets, lending, and games. Solana and Avalanche? Think of them like Android or Windows, which are competitors of iOS. So if Ethereum is iOS, how can people trade it? Well, I had the same question when I started. So Ethereum also acts like gas. Whenever the crypto powering apps are built, it uses up Ethereum. So what is Ethereum? For investors or traders, it acts like a currency or asset. For developers and users, it acts like gas, the network's payment for computation. So if the demand for Ethereum is heavy, the Ethereum prices rise, creating a deflationary effect. Well, let's move on to layer 2 networks. Now don't get me wrong, Ethereum's great, but it's slow and expensive when busy. So imagine if the main highway is jammed, layer 2 networks like Arbitrum are express lanes built on top. It then merges back into the main highway, which is Ethereum for security. That's how crypto scales for millions of users. Then there's DeFi, short for decentralized finance. Think of it like a robot bank. They issue tokens like shares, and you can own those tokens. Some examples are Uniswap and Aave. Uniswap is a robot stock exchange where you swap tokens without a broker. Aave is a robot lending service where you can borrow crypto instantly, no banker needed. And tokens of these DeFis, you can think of them as kinda like stocks, but not really. If the Uniswap exchange does well, you can expect the prices to rise, but a lot of it is speculation. You do get voting rights, like voting on fees, upgrades, etc., but you don't legally own a part of it. Think of it like chips in a casino. You own the chips, but you can't force a casino to share its profits. So to summarize, remember this. DeFi tokens are share-like in how they trade and give governance rights, but they are not stocks. You don't legally own the protocol or get dividends. You just hold influence and speculation power. Now, not every crypto swings like crazy. Stable coins like USDT, USDC, and DAI are like digital dollars. One USDC is about $1. Since USD physically cannot be used in the cryptocurrency world, stablecoins peg their value to the dollar, thus creating stability and trust, which ultimately reflects the trust on USD. Behind every app is the plumbing. That's where infrastructure tokens come in. Some examples are Chainlink and Filecoin, which issue tokens for people to own and trade. Chainlink is like a weather report for blockchains. I'll share an example. Since blockchains work off-network, they wouldn't know the current price of Bitcoin. Chainlink tells DeFi apps the real price of Bitcoin so the smart contracts in the network can get executed reflecting current prices. Filecoin is like a decentralized Dropbox where people rent out extra hard drive space and get paid in Filecoin. These tokens fuel the services that make the crypto world work, and you guessed it right. The price of these tokens depend on the performance of the project, and just like DeFi tokens, they have no legal ownership, no legal recourse, and no guarantee of the profit sharing. Next up, we have exchange tokens like Binance or Crypto.com. Binance issues BNB tokens to public. These exchanges mimic a normal exchange and help you trade cryptocurrency with your money. You hold their tokens, which means you are betting on their performance. If you hold these tokens, they give perks on that exchange like trading fee discounts, access to special features, sometimes token burns, which means the exchange buys back and destroys some tokens to reduce supply akin to share buybacks. Then we have consumer Web3 and NFTs. An NFT is like owning the original Mona Lisa painting instead of a poster, even if it's digital art. Doesn't make sense, right? Why can't you just right-click and save? Well, you're not wrong, but there are legit NFTs as well, like concert tickets or memberships NFT. Think of you buying a ticket on booking.com in your name. It's proof you have access. In-game NFT, where you truly own that cool skin. Real Estate Deeds NFT, which is a tamper-proof title. Metaverse tokens like Mana? Think of them like the monopoly money of virtual worlds, which you use to buy virtual land, clothes for your avatar, or even a virtual coffee shop. Last but also the least is meme coin. I was thinking to just skip it, but, well, I didn't. They're literally memes and jokes that became currencies. Dogecoin started as a joke about a dog meme, and now it's worth billions. Hawk through a meme coin might refresh your memory a bit. They don't run apps, they don't power blockchains, they run on community hype and also when Elon Musk tweets. So, the main question, how to use all the information that I gave you as an analyst would. First, map the landscape. Classify any crypto asset by its core use case. Is it a currency? Is it a DeFi? This helps identify relevant comparables and performance drivers. For instance, compare a new smart contract chain against Ethereum and Solana on network activity and security, rather than against Bitcoin. Step 2. Identify market leaders. Focus on benchmark assets in each sector. For example, BTC for store of value, Ethereum for platforms, Uni for decentralized exchanges. These blue chips often set sector trends, similar to how Apple or Meta can move their respective sectors. Third, watch sector rotation. Just as equity sectors rotate with economic cycles, crypto sectors can go in and out of favor. Monitor capital flows. For example, a surge in DeFi TVL or NFT trading volume may signal market rotation into those segments. Fourth, use traditional finance analogs. Leverage familiar sector metrics where applicable. If you're analyzing a DeFi lending protocol, examine it like how you would analyze a bank on loan volumes, collateral quality, etc. For a base blockchain, think of network throughput and fees like the revenue of a stock exchange or clearinghouse. This builds intuition using known frameworks. Lastly, stay adaptive. Be prepared to reclassify as the industry evolves. New trends like AI tokens, decentralized physical infrastructure networks, etc. may require adding categories. Keep an updated taxonomy. So I hope you guys learned the basics of crypto. In the next episode, we will dive deeper into POS and POW. Once we finish the learnings, we will also analyze a cryptocurrency of your choice at the end of the series. Like and subscribe if you found this video helpful.